Hey everybody, this is Paul doing a little pre-market video here after the latest GDP report just came out, which came in negative. I'm going to try and go over what in the world is going on there and what's causing those issues. I was going to wait until probably the first to do this video to get a complete April roundup, but I can kind of get a look at what's going on and get a general idea. It's a good roundup of where we're at and where we think we're going here. So this is the portfolio so far for the month. This month has been just a complete train wreck. Um, this says down 8.29%. I've increased the dividends from 3,189 to 4,200 though. That's just pretty much what I showed in my last April video. Took out that big position in QYLD as I promised. This is currently what the income chart looks like. So I have these right here that pay my bills. This VA one's actually about to go up. That's more of a personal issue, just different things with like a medical condition and whatnot related to my military service. But I'm expecting this to actually go up dramatically. Um, so now that I have my dividend income exceeding my bills, um, by an amount here, I've begun to add back into different positions. Um, different positions I was in previously. So we have O, main. These are the ones that everybody grabs. Um, ORCC. This is very similar to main. Um, go in here, click on ORCC. Um, where's this one? I believe this is the one that's just like main, or maybe it's CWL. I need to check it out. But I added those two positions. They're just high yielding accounts. Yep. So this is the one that's like that AWF fund. They where is this CLM right here? This is like that AWF fund that I have up here. These are basically just small business lenders, I guess is the best way to put it. And then ORCC is very similar, but they serve more like the clients that Maine serves. So everybody's piled into Maine right now. The only difference with ORCC is this is a quarterly dividend payer. Um, so it's kind of like Maine, but without the you can see the dividend yield on it, but it's kind of like Maine, but without the monthly thing going on. So you can see it right there. So I added that. Pretty cheap stock. I'm going to add some positions in here. These won't be big positions. This one, CLM and ORCC won't be big positions because they're exposed to high yield credit or high yield loans. So if the market tanks, these will tank pretty hard. Um, but and then obviously I added Intel, PPL, just to get some kind of utility exposure. Verizon, T obviously added those back in. Intel I added back in because I guess one of the subjects I want to talk about on this video, and it's one that I don't really talk about very much, but it's affecting a lot, and that is where is this at? I took a copy of this off of is that we have a currency problem is the best way to word it. Typically in the U.S. we have a strong dollar, um, like position. That's what all the presidents take. Trump was the only one that kind of said he wanted the weekend, but then he quickly reversed himself when he realized what that actually meant. Um, it's okay to have a strong dollar. It just can't be too strong, or else you start getting this. So this is the recent GDP report, and somebody was nice enough, as you can see, they were nice enough to put this into a very something that's very easily readable. Um, so this is basically stimulus. This is when they were sending checks out to people. Obviously, consumption went through the roof, and the market followed along. Consumption is you and me, um, basically buying stuff. Big purchases, like washers and dryers, that kind of stuff. As you can see, once the effects of stimulus, and this is why it was so stupid. It was so stupid when economists kept saying, "Oh, well, the consumer has all this stimulus." No, the stimulus was gone by here. It was only 5 grand. Like, and a lot of people either spent that on rent or they spent that on like different things or they invested in it. So it's you can see consumer spending went back to its historical norms here, and it's kind of averaged out. Private investment picks up around the end of the year. What's dragging us down right now is net exports. You might be asking what net exports is. Net exports is us exporting to other countries. The problem is right now is China's in lockdown for the most part, and also Europe is having very serious issues related because they are heavily depending on cheap fossil fuels, or they were dependent on Russia. But there's no telling what's going on over there right now with those guys. But it's causing their GDP to go negative for very different reasons than our GDP is going negative. Um, it's a very strange issue we're having right now. So basically, what's going on is the Chinese central bank is being forced to ease because they have a massive real estate bubble. They have a massive, massive, massive real estate bubble. Evergrande was just the beginning. There's multiple companies that below Evergrande that have major issues. They took on way too much debt. They changed the rules at the last minute while everybody was holding that debt, and they allowed this instead of deflating a bubble slowly, which apparently no central bank and no government in the world knows how to do. Instead of deflating it slowly to get the risk out of the system and then deal with the inventories that are there, China did these things. I think it was like called the three rules or whatever last November that took out Evergrande. It effectively took it out. It reduced a lot of the risk in their system, but it caused a lot of problems because risk was basically running the show over there. Um, so they're easy. Europe, if you listen to Christine Lagarde, whenever she's asked about inflation, she says something very different from what Powell is saying. So Powell used to pretty much say the exact same thing as Lagarde used to say. Powell used to say it's supply side driven inflation. We can't do anything about that. And then they changed in November of last year, and you can see, they changed in November of last year to say we will be able to do something about it. We just have to raise rates, and we can avoid a recession. So you might be asking yourself, well, why are the markets up right now? What's going on here because the market's just open. So it's so weird. So it's basically the Europe is easing, so the euro, their currency, is weakening by a lot. China is easing, so their currency is weakening by a lot. See the straight line straight up right here? Okay, so that's the yuan. When you go over here to this currency thing, this is right here on CNBC, you can look at it yourself. And you can see everybody, this is what everybody on Twitter is freaking out about. And this is a very big problem. Currencies aren't supposed to move like this. Currencies aren't supposed to do this. This is just not a normal thing. And the problem is right now is Japan is more concerned about keeping their interest rates low versus dealing with inflation the way that everybody wants them to deal with inflation. I hope that makes sense. So they're worried about what higher interest rates will do to their economy. So they're buying bonds that are being issued, which is in turn weakening their currency by a lot. They are well aware of what they are doing. And you can see Japanese currency versus the USD is just tanking really bad. Like they're just losing. So what's going on is when we go back over to our GDP chart, And this started to happen. So as you can see, this started to happen. It went up at the beginning of the quarter, and then it went up, then it went up, and then it went up. But if you look at the other charts of when their currency started weakening, it was earlier in the quarter, and that's when they started having those issues. So there's a chance that this next line. So there's a chance. I don't. The some these numbers tend to get adjusted a lot. Okay, so this could get adjusted positive, and it could be above, depending on maybe if like federal spending was wrong or maybe net exports was off. But they tend to get adjusted in the direction, so it could be actually worse. But it's worse because of our exports, and we don't. It's so weird. So net exports has had a big weighting this time around, and you could get another GDP report back over here for Q2 GDP where it looks very similar because this formula is not going to change unless there's like a stimulus that comes out of nowhere that gets spent immediately, which isn't going to happen. So you could have a GDP report where this net export number is actually worse because these countries are allowing their currencies to weaken a lot. Um, that's kind of a really big problem on how they deal with that. They're going to have to figure out how they're going to deal with that. Um, because right now the dollar is just a monster. It's just a beast. It's just a go-to currency because our Federal Reserve is tightening. So what our Federal Reserve sees is this. They see business investment is right where it normally is. But if you notice in Q2 right here, it kind of dropped off. And that could be COVID or whatever. But if you notice, consumer is healthy. So even though the market is just having a panic attack right now over higher rates, and you can see this is the market having a complete panic attack. This is 17% in 1 year, and in like the entire tech bubble, like the Teladocs of the world, the ARK investments of the world have just completely popped. Those are just done. But and the only reason my portfolio is down is because I took on such huge exposure to basically these two right here. You can see you can just organize this. Um, AFB is that exposure to the bonds, which have been selling off, and then these two down here are exposure to tech, international and domestic. So it's pretty obvious what's dragging down my portfolio. And then this is credit right here. This section right here is credit, and then this right here would be down just as much as this if I put that 10,000 in February versus when I did in April. This would actually be down far more. This would be down 12%. So this number would actually be worse. So where are we headed, that kind of thing. Um, at some point something breaks. Um, Either the Chinese decide they don't want their currency that weak, so they go in there and readjust, or they do their magic that they do to try and get their currency back under control, or the Japanese change their tune after, because some people are expecting this. Some of the numbers being thrown around on this are pretty ridiculous. Like they're expecting this to go up to 150. That's a pretty big problem. Um, or the Federal Reserve changes their tune. Somebody like at some point, somebody like something's got to somebody's got to move, and it's going to have to be Japan, because Japan has they're effectively going to be forced to. You can't just keep weakening your currency like this. Um, Especially when you're importing oil. When you're importing, because this is the problem. The oil is priced in dollars. This is a major problem for Japan. Oil is priced in, they call it the petrodollar for a reason. You can't keep weakening your currency. At some point, the Japanese central bank is going to have to say, okay, our rates, they're going to have to stop trying to control their rates the way that they are. or they're going to have to stop doing like just something's going to have to break because the Federal Reserve does not look like they're changing course. So if the Federal Reserve came out tomorrow and said, "No, we're not going to raise rates. We're going to stay right here," the dollar would weaken significantly. Like so, this would all kind of go back to where it was. Like we would kind of go back into this like kind of over here in this little area down here. But right now, that's definitely not the case. So the Federal Reserve has every incentive in the world to hike more. And what's weird is you could potentially see a recession because it's 2 quarters of negative GDP. So if this goes further negative or stays negative, and then you get another negative quarter that stays negative, that's 2 quarters of GDP. So you wouldn't actually know until September because that's when the data gets finalized or would probably get finalized and all that. So what we could see maybe going into the summer is consumption goes up. But consumers tend to react to this type of information high. What consumers see right now is high inflation, higher prices. They see high oil prices because these price drops, these these price drops that are happening don't translate to the pumps until 3 or 4 weeks later. Um, so consumers could sit there and say, "Oh no, we could be going into a recession. We could be having a problem. We don't like the direction of the company or country." You could see. You got to watch consumer sentiment and see where that goes. Consumer spending is going to be the big one. Um, but yeah, that's kind of a problem. We have a problem with currencies right now. We have a very big problem with currencies. Um, so we have to kind of, but the market, I can tell you what the market is looking at right now. The market is looking at this top part of the graph. They're not even paying attention to this bottom part of the graph and treating it like a blip. This is just a one-off kind of thing. Because if you notice last year, right around this same time for Q2, you see how net exports went up. Well, that's before the dollar was ridiculously strong. You can kind of see last year the dollar actually weakened. This is Q2 in here, right? April to June, this kind of area. You can see the dollar actually weakened. But look at what's going on. You can kind of get the general idea. It kind of weakened right here, but there's no new federal spending. This is going to continue this might continue to be a drag. I don't know. Like we're going to be kind of cutting it close on a recession here and it's called a technical recession, where you just have 2 quarters of negative GDP growth. That's all it takes. Um, I don't know. It depends on how consumers react. You also have the fact that rates went through the roof in March, and that's going to pull down housing demand. So that could start to feed through into the economy. So you have to kind of watch it. What are my moves currently? Like what's going on with me? Like what am I doing? Currently, I'm just adding positions. That's literally all I'm doing. I haven't added any. I can't lie. I think I added 1 or 2 shares. One share there, one share there. Um, I keep adding positions to AFB um, because eventually I think I probably want to do something where I move. Yeah, I have no idea what I want to do. So you can kind of see what I've done here. I've turned dividend reinvesting back on for a majority of my portfolio. Pretty much anything outside of the monthly bill thing. I'll add the AFB because that's tax-free income. Especially if it's gonna, if it stays down like this, you could buy it cheaper, and it has a 4.63% yield on it for municipal bonds, which is really nice. So I'll add positions in there. All of this is kind of where I want it to be. Um, I guess I should put out like my 2 cents because like I looked up. Apparently, QYLD is like a very dramatic thing on YouTube, and everybody puts that in the title of their videos. My opinion on it: you take a position in it, you turn off dividend reinvesting, and you use it to pay a bill. That's my opinion on it. That's what you use it for. A lot of people keep dividend reinvesting on it, but as one guy pointed out to me, and I had a conversation with him on Twitter about this, is if he could pull the chart up for me. take it out of the max, and if you look, you are not buying this because the stock price goes up. Okay, like if you take a look at this, this is the you know you're not buying this because the stock price goes up. People buy this because it's literally that you use it to pay a bill. It's a steady source of income in retirement. I guess a lot of people stick this thing in their retirement accounts. Um, yeah, you're not buying this. Like you're this is literally something you buy. You put 10 grand in it, you turn off dividend reinvesting, and then you just get your dividends every month. And then you put the dividends into something that you think will appreciate in price, like Intel, PPL, Verizon, T, something like that. Even BST, for example, BSTZ. These are ones that these two right here track the NDX, the Nasdaq. So these two would go back up in price, especially this one once the global stuff recovers. But you put that money into places that you think the stock is going to go up over time, um, and then you turn on dividend reinvesting. Like QYLD is just not that. It's just not that. You can't justify that looking at this chart. It might have some stock price appreciation, but it always kind of goes back down. And you can literally see it's just kind of like if you could, I don't have the thing where you can draw trend lines here, but you can kind of see the trend. So that's not, I don't use it for that. That's my opinion on that. I don't know why people make 40-minute videos about QYLD. You just don't need to. It's that simple. But and you can literally see. There's my power bill. There's that. My power bill this time of month or this time was 87 bucks. I take the difference between those two, 142 minus 87, and drop that into something down here. There you go. That's how simple that is. It's no need to be more complicated than that. So that's where we're at right now, and you can kind of see that. You can actually see that GDP report kind of feeding into the market right now in terms of like sentiment and buying and whatever. And that GDP report just explained a very large amount of things that you're seeing right now. It's like how can you have U.S. companies that keep putting up these earnings, like these record earnings, like hitting their earnings estimates or going past them? Like how is that possible? And the simple thing is the U.S. consumer and business investment in the U.S. is strong. It's just the world is falling apart. We're basically on an island at the moment. Um, and we've been here before, and it doesn't stay like this for very long. Eventually, like inflation or something, the Federal Reserve, something just takes it down. So I still think the market is very early on this recession talk. I still don't think it's until Q3 or Q3 2023. I still think it's very far out. We're definitely gonna, it's it. If you look at that GDP chart, I think we're definitely going to be kind of flat. It reminds me a lot of 2019, where it was starting to slow down and just kind of slowing down. There wasn't too much new federal investment, you know, but we could see. We'll have to see. So I don't know, but that's where we're at right now. That's kind of my thoughts. Like I said, right now I'm just adding little positions here and there. I'm going to be buying into any weakness. Um, That's if it breaks, Federal Reserve drops the rates, and then party back on. Enjoy your next bull run. But we have to kind of see what's going on with these currencies. I think that's kind of where the issue is going to be. You can see it starting to already drag down our GDP. So we'll have to see. But let me know what you think. Y'all have a nice day. Thank you.